Welcome to our in-depth financial analysis of Pinterest, ticker symbol PINS. Today, we're diving deep into the financial health of this unique social media and visual discovery platform. Our focus will be on three critical areas: working capital, liquidity, and cash flow. These metrics are fundamental for understanding any company's operational efficiency, short-term solvency, and long-term sustainability. Pinterest has carved a niche in the digital advertising landscape, but is its financial foundation as robust as its user engagement? We'll break down the numbers, uncover key insights, and ultimately provide an informed perspective on whether PINS is financially strong for investors and stakeholders. Let's get started. Let's begin with working capital, a crucial measure of a company's short-term financial health and operational efficiency. Simply put, working capital is the difference between current assets and current liabilities. A positive working capital indicates that a company has enough liquid assets to cover its short-term obligations, suggesting good operational efficiency and financial stability. For a growth-oriented tech company like Pinterest, maintaining healthy working capital is vital for funding ongoing operations, managing day-to-day expenses, and seizing immediate opportunities without external financing. We'll examine PIN's specific components of current assets and liabilities to understand this balance better.
Now, let's break down Pinterest's current assets, the resources it can convert into cash within 1 year. For a company like PINS, these typically include cash and cash equivalents, short-term investments, and accounts receivable. A robust cash position provides a strong buffer against unforeseen challenges and allows for strategic investments. Short-term investments indicate prudent management of excess cash, while accounts receivable represent money owed from advertisers. Understanding the composition and size of these assets gives us insight into PIN's immediate financial firepower. For illustrative purposes, let's consider a scenario where PINS holds approximately $2.5 billion in cash and cash equivalents, $1 billion in short-term investments, and $0.5 billion in accounts receivable, totaling $4 billion in current assets.
Equally important are current liabilities, which are Pinterest's financial obligations due within 1 year. These typically include accounts payable, deferred revenue, and accrued expenses. Accounts payable represent money owed to suppliers and vendors, while deferred revenue signifies payments received in advance for services yet to be rendered, common in subscription or advertising models. Accrued expenses are costs incurred but not yet paid. A manageable level of current liabilities indicates responsible financial management. Using illustrative figures, let's assume PINS has $0.3 billion in accounts payable, $0.6 billion in deferred revenue, and $0.4 billion in accrued expenses, leading to a total current liabilities of $1.3 billion. With an understanding of current assets and liabilities, we can now calculate PIN's liquidity ratios, the current ratio and the quick ratio. These ratios are vital for assessing a company's ability to meet its short-term obligations. The current ratio, calculated as current assets divided by current liabilities, gives a general measure of liquidity. The quick ratio, also known as the acid test ratio, is more conservative as it excludes inventory, focusing only on the most liquid assets. Given our illustrative figures of $4 billion in current assets and $1.3 billion in current liabilities, PIN's current ratio would be approximately 3.0x. As a tech company with minimal inventory, its quick ratio would be very similar, approximately 2.8x, assuming minimal inventory. Ratios above 1.0x generally indicate healthy liquidity, and PIN's illustrative ratios demonstrate strong financial solvency. Moving beyond the balance sheet, the cash flow statement offers a dynamic view of how PINS generates and uses its cash. This statement is often considered more indicative of a company's true financial health than just net income, as it tracks actual cash movements. It's divided into three primary sections: cash flow from operating activities, investing activities, and financing activities. Operating activities show cash generated from core business operations. Investing activities detail cash used for asset purchases or acquisitions. Financing activities reveal how cash is raised or returned to investors. The net change in cash across these three areas tells us whether PIN's overall cash position is growing or shrinking. Understanding this flow is critical for long-term sustainability. Cash flow from operating activities is arguably the most important section for assessing a company's core business performance. It represents the cash generated from PIN's primary revenue-generating activities, adjusted for non-cash items like depreciation and stock-based compensation. A consistently strong, positive operating cash flow indicates that the business is healthy, profitable, and self-sustaining. It shows Pinterest's ability to generate sufficient cash internally to cover its operational expenses and potentially fund growth without relying heavily on external financing. For our illustrative scenario, let's consider PINS generating a strong positive operating cash flow of $800 million, reflecting robust core business performance and efficiency. Beyond operations, the investing and financing sections of the cash flow statement reveal how PINS is strategically deploying its capital and managing its funding structure. Investing activities typically include capital expenditures, CapEx, for infrastructure, as well as acquisitions. Significant investments here can signal future growth, even if they result in negative cash flow in the short term. Financing activities show how PINS raises money through debt or equity issuance, or returns it to shareholders via dividends or share buybacks. For illustrative purposes, let's say PIN spent negative $200 million on investing activities, e.g. CapEx and acquisitions, and negative $100 million on financing activities, e.g. share buybacks, reflecting a company that is investing in its future and returning value to shareholders. Pulling together all our findings, let's summarize Pinterest's key financial strengths and potential weaknesses. On the strength side, PINS demonstrates a robust cash position and strong operating cash flow, suggesting a highly efficient core business capable of generating substantial cash internally. Its healthy liquidity ratios, such as the illustrative 3.0x current ratio and 2.8x quick ratio, indicate excellent short-term solvency. However, potential weaknesses for a company like Pinterest include market dependence on advertising spend and the continuous need for investment in technology and user acquisition, which could lead to increased CapEx. While these are not necessarily weaknesses in a negative sense, they are factors that require careful monitoring by management and investors. So, after this deep dive into working capital, liquidity, and cash flow, is Pinterest PINS financially strong? Based on our analysis using illustrative but representative figures, PINS generally presents a strong financial position. Its robust cash generation from operations and healthy liquidity ratios provide a solid foundation. While factors like market dependence and ongoing capital investment need consideration, PINS appears to be prudently managing its cash and strategically allocating capital for long-term growth. For investors, this suggests a company with the financial resilience to navigate market fluctuations and continue investing in its platform. However, it's always crucial to integrate this financial analysis with a comprehensive understanding of market dynamics, competitive landscape, and future growth catalysts before making investment decisions.